Okay, testing. Sorry, guys. Yeah. Welcome to today's session. It's a breaking news and setups for what we can expect for the week ahead. All right. So it's going to cover a lot of the latest news, right? How it's going to impact the markets, right? It'll be presented by my colleague Keaton here today, right? We're just going to give it a couple of minutes to get everything set up. Right. The reason for this is because this is the first time that we're streaming a webinar live within the app. So if you guys are here, whether you're watching on Zoom, whether you're watching on YouTube, whether you're watching on the Vantage app, right? Yeah, today's this is the first session that we're doing it in a landscape format, right? So you guys will be very familiar with the app being in the portrait format, but today we're in the landscape format. So we're going to stream to you basically, right, some of the key news setups that you can watch out for the week. Okay. There might be, okay, we got see Atak, right? We can see that we can see a message come through. Thank you. All right. Yeah, thank you. All right, you can see a message come through. So that's nice. All right, we'll try our best to monitor with a couple of screens around to try to monitor the questions coming through. But yeah, we might probably prioritize the ones that we see on the app because there's quite a big number of you guys watching from the app. All right, so yeah, today's session will be focusing on breaking news and setups, right? What I want to encourage you guys is that anytime you have questions, feel free to send it through, and of course feedback, because this is our first time that we're going to do a live we're going to do a portrait format on the phone, right? I believe depending on the size of your phone, sometimes you might have certain parts that are cut off, so we're trying to optimize it so that it fits well for the majority of phones. But for some phones like mine, for example, mine's a foldable phone, right? And it is this format, or if I fold it, is different resolution, so it might have different parts that are cut out. So do not hesitate to send in your feedback. Say that, okay, I got this part at the top which is cut off, I got this part by the sides which are cut off, right? Let me know. Let us know. We are collecting the feedback, and we just try to tweak the resolution a bit so it fits the majority of phones, which I believe would be normal size phones, right? Okay. All right. Yeah, we got questions coming through already asking like what's the best place to receive relevant news for trading, right? I mean, I'll be handing over time to Keaton soon, but a great place to look at, Vantage has its own economic calendar, which you can take a look at. So what I'm going to do is I'm going to, are you able to see? Okay. What I'm going to do is, we do have a page over here, right? You can go to Vantage over here. I think education and tools, they have market news and analysis, right? Between this and the economic calendar. So if you're talking about more, I guess the term is live and when the key news events are coming, economic calendar is one of it they can look at, right? So you can see all the latest economic what's the word for it? News events which are coming, and you can filter it based on your time zone. If you want to filter the instruments, right, it's a little bit tougher. You might need to go to Forex Factory for that. All right, but yeah, on Vantage, you go to live education, you can find the economic calendar here. Market news analysis, we do post there quite a bit. Little bits of market outlooks, what I expect for a day and week ahead, right? You can check it out too. All right, so I hope that answers your question, right? CBI news does impact. Okay, Patak, right? We will answer that in a minute. Okay, we'll answer that in a minute, right? Sometimes depending on the background of the image, it's a little bit hard to see the names that come through, right? So do forgive us if you need to jump around a bit and see where the questions are coming in from. All right, and just going to do one last thing, which is to ensure that the chats are up. Okay, we got participant chats. All right. Okay. All right. Anyway, let's begin today's session, right? Always remember that in this webinar, disclaimer, everything in this webinar is educational in nature. Nothing should be construed as investment or trading advice. Please do your own due diligence before you guys trade. Okay, right. As mentioned, today's session is going to cover on the key news events to watch out for the week. Keita has prepared a really comprehensive list of all the things that you should be watching out for, right? And of course, since this is the inaugural kind of like landscape mode webinar that we're doing, right? I want to encourage you guys to provide as much feedback as you can. Which parts are cut off, at the top, at the bottom, and left and right. Let us know, right? So we can further fine tune these webinars, to give you the best experience moving forward. Okay. Now I will hand over the time to Ketan, where he'll be touching on interest rates and credit spreads and the list of things, list of news events for the week ahead. Just let me close this off and ensure that everything's running. Got Zoom, we got that. All right. And if you need to use, the news events, economic calendar, you can come here. Okay. All good? Yeah. Okay. Now hand over the time to Ketan, right? Have fun. Right. Just let me see one more slide, okay? Fed Watch 2. Some of the top parts might be cut off a bit in a bit. Oh yeah, okay. It actually works quite well. All right. Okay. All right, good stuff. Thank you, everyone. Right. Have a great time with Ketan. Don't hold back on your questions for him because he's really good at answering them, all right? Yeah. Over to you.
Right. All right, thanks, Desmond. Hi, everyone. Okay, welcome to the webinar. Okay, so we'll start off by
Sorry, just let me update Ketan one more thing. Okay. Okay. Yeah. Okay. All right. Thanks.
All right, thanks, Desmond. Hi, everyone. Okay, so there's a lot of things going on in the markets over the last couple of weeks. So we'll just start with a recap of some of the major events that happened last week. So we'll start off with interest rates. So as we know, the Fed raised interest rates last week. They raised it by 25 basis points. So prior to every Fed meeting, to get an idea of how many basis points will the Fed raise rates, you can use this website called the CME Fed Watch tool. So if you Google that, it'll take you to a page where it gives you the probabilities of what you can expect the Fed to do. So going into this meeting last week on 22nd of March, there was almost 90% probability of the Fed raising 25 basis points, which is what they did. So the interest rate now stands at 4.75 to 5%. Okay, so the main takeaway from this meeting was obviously with the regional bank crisis going on in the US, and we have the Swiss banking crisis as well, with UBS taking over Credit Suisse. So financial conditions are tightening. The Fed has raised rates again by 25 basis points. And the forward projection from the Fed is that they are likely to raise rates again just one more time this year. So there's probably another 3 to 5 meetings, but based on what's happening so far, they are likely to just raise rates one more time because inflation is still not completely squashed. Inflation, although it has peaked and has been pulling back quite significantly, it is still historically at an elevated level. Okay, so as you can see here, this is the Fed funds rate chart. So it is now standing at 4.75 to 5%. This has been the highest level since July 06. So it is a pretty high restrictive level. And not only that, the pace at which they have raised interest rates is very quick and is obvious in this chart. As you can see, the last hiking cycle took place between 2016 to about 2018. And it was in a relatively measured manner. But recently, as you can see, in this past 1 year, they've raised it very sharply. There were some questions coming in. Just let me see if there's anything I can. Okay. All right. Okay. So no new questions. Okay. So this is where we are with regards to the Fed funds rate or the interest rates. At the same time, last week, 22nd March, when the Fed chairman Jerome Powell was making his was conducting his press conference, the Treasury Secretary Janet Yellen also had a testimony itself for herself. So basically, Because of the ongoing banking crisis, she made a statement where blanket insurance would not be discussed, and this actually caused the markets to sell off on the 22nd as well. So there's a lot of volatility in the markets, and news events such as this, which may happen at various times throughout the day, could happen. So, for example, this happened at about 3:30 p.m. US time. So that would be Singapore time about 3:30 a.m. So you can see a lot of the news, especially the US news related events take place obviously when it could be an overnight session for us, or when we're sleeping if you're in the general Asia time zone.
Right. Guys, I just need to jump in here for a while. If you guys do not have the landscape mode, please update your Vantage app to the latest version, right? Because the latest version has the landscape mode, right? So yeah, just a public service announcement for everyone. All right. Thanks,
no worries. Thanks, Desmond. Thanks. Okay, so we shall continue next. Okay, so as we know, there's a lot of stress in financial markets, but how do we try and quantify or visualize this stress level? So one way of looking at it is we have this spread called the FRA OIS spread. So basically these are forward rate agreements versus the spread between overnight index swaps. Okay, how this spread is calculated is probably a bit too technical and a bit too deep for this current webinar, but what we can see here is that as credits and this spread widens or it becomes larger, it means that there's more stress in financial markets. So as we can see in 2008, the spread rose to as high as about 180. And during the latest or the recent COVID pandemic, it went as high as 80. And currently, at its highest point 2 weeks ago, it hit about 60, and now it has pulled back to 40. So this gives you a general understanding of and also visualization of where we are in relation to the stress levels in financial markets, because we're always going to see headlines coming up every now and then, or the stress in the markets, but how do we actually quantify it, and how can we actually visualize it and appreciate it? So if you just Google US FRA minus OIS spread, it'll take you to it'll come up with a few results, and one of them would be this macro micro, which plots the chart for you. So with this, you get an understanding of where we are in terms of stress level in financial markets. Yes, it is relatively high, but it's not as high as what it was during 2008 and in 2020. So yes, there is stress in the markets. Volatility is high, so we can expect price to move across asset classes up and down. So we just have to be careful, and this is where you will have to track your data news and perform like technical analysis as well for your positions. Okay, so now we'll just cover inflation. So I'm just going to talk about a brief overview of where we are in inflation, because this hiking cycle started because of inflation, right? We had rising inflation over the past 1 year, and the Fed and other central banks have been raising interest rates to battle inflation. Okay, so here we have the chart for the CPI and core CPI of the US. So in the darker red line is the headline CPI, and the lighter red is the core CPI. So okay, so as you can see, the CPI, this is CPI on an annualized change, year-over-year change. So we can see for the headline CPI, it peaked in June at about 9.1%, and for the core CPI reading, it peaked at about 6.6% in September. So ever since then, the readings have moderated quite quickly. So the Fed raising interest rates has helped to tame or moderate inflation. Okay, so next, there are various components that make up the CPI. So we'll just look at a few of them. So we can see energy, which makes up 7% of the total weightage, had actually driven very high, right? So energy is made up of other components, but primarily it would be gasoline and natural gas. So gasoline is what we would call petrol, right? The Americans call gasoline, called petrol gasoline. So this is where your fuel prices, right? Your pump prices and natural gas is also used for heating and among other things. So as you can see, all these energy components have skyrocketed, but after that they have peaked and started coming down quite significantly. The other other major components of the CPI index is food and shelter. So food is captured here in the light blue line, and shelter is captured here in this purple line. So if you look at it, energy plus food and shelter make up 55% of the overall CPI. So these are quite heavy components. So if you track these three components, you can get a good idea of roughly where inflation is heading. So as we can see, energy has moderated quite significantly. Food also has been moderating, has peaked and moderated down. Only concern is shelter. So shelter includes your rent price and also your home prices. So as you can see, housing is still, in terms of CPI related calculations, housing is still one component that has yet to peak and moderate down. But overall, the trend in headline CPI and core CPI has been pretty encouraging. Next, we are going to look at PPI and core PPI. So basically, this is wholesale inflation. So again, similarly, core headline PPI peaked at 9.1% in June and has trended down quite significantly. And the core peaked in September as well at about 6.6%, and it's also now down. So that's a good thing that inflation is coming down pretty significantly, so that the Fed is not as aggressive as they need to be. Any questions? Just let me see. Okay, right. Okay. Now we'll just quickly cover the economy. So just to give everyone a state of what's the US economy is like. Because last year we had a lot of talk of recession, right? So what happened in the first half of 2022, the US did undergo technical recession. So what is a technical recession? Technical recession is when you have 2 consecutive quarters of negative growth, which is what we saw, minus 1.6 in Q1 and minus 0.6 in Q2. Because this was due primarily to a few things. One of them was the Russian invasion of Ukraine, plus the Fed hiking aggressively. So this had created a lot of tightened financial conditions as the dollar started to rise, interest rates rising. So this impacted economic growth in the first half of 2022. But as you can see, in the second half, the US economy has actually rebounded quite strongly. So we had 3.2% growth in the third quarter and 2.7% growth in the fourth quarter. So this is primarily, even though the Fed was rising rates, what happened the second half of the year was, if you had noticed, the dollar index DXY had actually peaked around the middle of the year and actually has started pulling back quite significantly. At the same time, the US bond yields, for example, if you look at the 10-year bond yield, that had also started to pull back. So this had actually loosened the financial conditions, which actually helped to spur economic growth in the second half for the US. And looking forward at the current forecast for the first quarter of 2023, the Atlanta Fed GDP Now model is forecasting 3.2% growth. So as you can see, after 2 quarters of relatively shallow negative growth, the US has rebounded quite strongly. And for this year, at least for the first quarter, we're expecting growth of 3.2%. And I think for the first half of 2023, the US at least should still be growing pretty steadily. Next, we will just look at the ISM PMI report. So the ISM is the Institute for Supply Management, and PMIs, we know, which are Purchasing Manager Index reports. So we are looking at the manufacturing and services reports. So after the COVID recession hit, the COVID pandemic hit, economies bounced, stock markets bounced. So we had strong growth in 2021 for both the manufacturing and services sector of the US. Throughout 2022, services held up relatively well, whereas manufacturing was actually trending lower. Okay, what to take note is any reading above 50 is considered expansion, and any reading below 50 is considered a contraction. So what has happened, where we are now, the manufacturing sector of the US is actually in a contraction territory, whereas the services economy is actually rebounded and is now in expansion territory. So what we are seeing now is a two-speed economy in the US. So basically, you have the manufacturing sector, which is slowed down and continues to be in contraction territory, whereas the services sector is the one driving overall economic growth. So moving forward, we are likely to see this trend continue. Okay, here we look at the chart of the S&P 500 with respect to its year-over-year change. So the blue line is the index itself, and the orange bars are the year-over-year change. So as you can see, the as S&P 500 has pulled back from its high at the start of 2022, and now it is pulled back quite on an annualized basis. It's pulled back almost about 20%, which is not as deep. The correction has not been as deep as it was in 2008, and also during the tech crisis of 2001 to 2002. So yes, that we are in a bear market, although the S&P 500 is probably trading just above the bear market level now. But yeah, you can see the pullback is there, but it hasn't been as deep as in past corrections. So why this is we're talking about this with relation to ISM, because if you see here on this next chart, the green line represents the year-over-year change of the S&P 500, which here is visualized as the orange bars, and now here it is in green. And the dark red line is actually the PMI average. So the average of the PMI readings for the manufacturing and services sector of the US. So as you can see, there's a relatively tight correlation between the two. So as when PMIs bottomed in 08 and it started rising, the S&P 500 also bottomed around the same time and started rising together. And in general, the trend is quite tight, as seen from 1997 to present. So as you can see now, here, the PMIs were moving down, as well as you could see the year-over-year change of the S&P 500. We've seen this bounce in the PMIs. So moving forward, if the economy if the economy can continue to grow steadily, we may see the S&P 500 probably range bound around this level. So I don't think we will see a good, strong recovery, perhaps, but at least in the near term, we should see the S&P 500 probably stabilize and range bound between probably 3,900 and 4,100, at least in the short term. Next, we will look at ISM prices and CPI. So the ISM, just going back here, so there are several components in each report, and prices is one of them. So this tracks the prices of goods and services, so manufacturing and services. So if you look at the average of the manufacturing and services prices together with CPI, we tend to see that the ISM prices actually lead the CPI, right? So from 2003 up to now, it's been pretty obvious, especially here. So even before CPI started rising, before inflation really started rising, you could actually see the ISM prices actually started to lead and head up first. So this should have been a warning sign for many for investors and traders to know that, oh, okay, inflation is rising and it's very likely that CPI is going to follow suit. So when that happened, you should have been aware and manage your positions across your asset class, manage your positions and probably be more cautious. So it is good to see that ISM prices have moderated fairly strongly in 2022, but just recently this year, the last two readings, we've seen it bottom and start to head up. Now, will will this result or translate to inflation picking up in the broader economy? Hopefully that is not the case, but if ISM proves to be accurate once again, it is likely that we may see overall inflation remain elevated. Maybe we won't get a big spike as what we saw at the start of the year, but perhaps it will take a longer time for inflation to probably pull back and moderate again. Okay, now just to cover quickly the unemployment rate. So as you can see, unemployment rates currently stands at 3.6%. Earlier this year, it hit 3.4%. This was the lowest level in almost 40 years. So the US economy or the labor market is very strong, despite what we are seeing or reading about the tech layoffs. Yes, there have been many layoffs from the tech sector in the last quarter of 2022 and also at the start of this year. But the tech sector represents, I can't remember exactly, but not a very large sector of the overall labor market. So there are a lot of people who are still employed, and this also you can see in NFP. So non-farm payrolls are the job numbers that's tracking. So we can see that despite the tech layoffs, which have dominated headlines, non-farm payrolls are still strong. They've surpassed the COVID high, and inflation and unemployment rates are also at historically low levels. Another important factor is wage growth, right? So because of rising inflation, companies are also paying their employees more. So when you have strong wage growth coupled with low unemployment rate and a tight labor market, it means consumers are still spending. So when consumers are still spending, that means the economy is growing. And why do I say that? Because the US economy or GDP, nominal GDP, is actually driven by private consumption. So the consumer spending makes up about almost 70% of GDP. So when you have a strong consumer whose wages are matching inflation, they will continue to spend on discretionary and non-discretionary items. So as such, we can expect the US economy to at least continue growing pretty steadily as seen in the previous slides. Okay, now we'll touch on equities. Okay, so here we have a weekly chart of the US 10-year bond yield and the S&P 500. So as you can see, 2022 was when the Fed started to raise rates. So as the Fed started to raise rates, bond yields followed suit as well. So as bond yields rose, the dollar index rose, financial conditions tightened. And because of that, equities started selling off. At first, it was a slight pullback. And then after that, the pullback got deeper. And this was when the S&P 500 briefly entered a bear market. And it's been trending, it's been ranging, I would say, between about 3,600 and about 4,100. And in the second half of the year, this was when, although the Fed was still raising rates, this was when financial conditions actually started to loosen. So what I mean loosen is the dollar index was also falling, and we also had bond yields which were falling as well. So during these periods, you could see the equity markets actually stage a bear market rally, if you could, yeah. So we've had we've had 1, 2, 3 major rallies since 2022. So as you can see, when yields fall and dollar index fall, the financial conditions loosen, and generally we can expect a bounce in equities. So this is what has happened. Basically, it's a tale of two halves, right? In the first half, 2022 to June or August, you could see equities selling off. So basically, this is where you could identify well, you know, this is a downtrend, so you would use technical analysis to identify your entry points, at least at the indices level, to go to short the market as well. And then here in the second half, as financial conditions begin to loosen, you could actually look to capture or to capitalize on those short-term rallies here. Okay. Another thing I like to look at is the S&P 500 versus the VIX and RIDEX. So what is the RIDEX? The RIDEX is an asset ratio, that which is used to evaluate market sentiment. So as you can see, this is the S&P 500 here in red and green candles. Just behind it, we have the VIX, the volatility index, and then we have the RIDEX ratio here. So looking historically, when the RIDEX ratio is high together with the VIX, it has actually captured the market bottoms pretty accurately. So what it means is when the RIDEX ratio is high, it means that there's a lot of money that's been moved into money market funds and out of long equity funds. And obviously when the VIX is high, that's when we know that volatility is at its highest. So by looking at these two on a weekly chart, you are able to roughly identify the points in the index where there's a potential bottom, and together with technical analysis, depending on your time frame, you could do a weekly, daily, or 4-hour, you will be able to identify potential entry points for the long and for the shorts as well. Okay, now we'll look at market breadth. Okay, market breadth is something that's pretty important. Okay, so what is market breadth? So the S&P 500 is an index. It is made up of the 500 companies, right? So, and then the market breadth actually calculates the number of, or the percentage of stocks that are above the 200-day moving average. So when you have the stock is trading above its 200-day moving average, you can say that this the stock is in a bull market, or it's in a bull trend. It's in a bullish trend. So as you can see, the stock market was rising after the bottom in COVID, and then the market breadth was also relatively strong. So anything between, I guess, 70 to 80% would be a good indicator of a broad-based rally. So this was what drove the index higher. But also what happened was for the S&P 500 in the middle of 2021, the market breadth started to deteriorate while the index still went higher. Why? So what was actually happening? So the index, as you know, is made up of various companies. So the mega cap companies such as Microsoft, Apple, Amazon, these were the companies that, because they have a higher weightage in the index, they were the ones carrying the S&P 500 index to greater highs, whereas the smaller and medium-sized companies were actually started to correct. Some of them maybe even entered bear market territory towards the end of 2021. And market breadth really deteriorated in the middle of last year. And since October, market breadth has picked up. So we can see this was a very strong, well, not strong, but a broad-based rally, which we went from 3,600 to about 4,200. So these are the SPY ETF is just to give you an idea of what are the top 10 holdings of the S&P 500. So the SPY ETF is here. So you can see these are the top 10 holdings and the relative weights. So if you look at the top 10 holdings, they make up about 25% of the index. So that is why these companies were the ones carrying the S&P 500 to all-time highs, whereas the other components were actually correcting. So a similar tail can be seen in the NASDAQ 100. And actually, this is more obvious. The NASDAQ 100 actually started, the breadth of the NASDAQ 100 started deteriorating in early 2021. So that means a lot of small and medium-sized, medium-cap companies were already pulling back significantly as the NASDAQ was making greater highs. And once again, you can see the top 10 holdings here actually make up almost 50% of the index. So you have the likes of Microsoft, Apple, Amazon, Nvidia, Tesla. So these were the companies that were carrying the NASDAQ 100 to new highs, whereas a lot of the smaller and medium-sized tech companies were actually probably in a bear market already. Okay, now we shall move on to gold. Okay, one way I like to track gold, or to get an idea of where gold is headed, is to look at real rates. Okay, so what are real rates? Real rates are your bond yields, for example, the 10-year treasury yield minus inflation expectations. Okay, so what we have here is the price of gold per ounce in yellow and the inverted real real rate in black. So as the real rate goes more negative, so as it decreases, so please note this is an inverted scale here. So as it goes from, for example here, from 2.4%, and the real rate was decreasing all the way to negative, probably about 1% here. So during this period, you could see gold price actually rise up. So what happens here is, as real rates go negative, gold becomes a better hedge against inflation. So that means your bond yields are not yielding high at a high level. So investors are likely to shun bonds and will buy gold instead. So this is what this chart is trying to visualize or illustrate. So in the middle, in about 2013, 2014, real rates actually bottomed and started rising again. So when that happened, gold actually peaked as well. Gold peaked and started following real rates down as well. So when in this scenario, gold becomes less attractive as an inflation hedge, and investors generally start buying the 10-year bonds because they yield better. So and then from 2013 to about 2018, there was a bit of sideways action in terms of price action for gold. It didn't really go, there was no real clear trend, and as you can see, it was because real rates were just fluctuating between 0 and 1.2%. So about 2018, 2019, real rates started to decrease again. And similarly as what we saw in 2008 to about 2013, gold price followed suit. So that's when gold rose strongly and reached almost hit, okay, this is a monthly, okay, but it has hit more than $2,000 per ounce. And now what we have seen is real rates starting to rise again because central banks around the world are rising the rates, increasing interest rates, so bond yields have gone up. But you would think that gold, in theory, or if you follow previous history, you would think gold should correct pretty strongly as well, but it hasn't. This can be attributed to a couple of things. One is central banks. Central banks have actually been buying gold quite heavily in 2022. So this was the second highest purchasing spree on record by central banks. So this is one of the reasons, despite real rates rising, gold has actually held up pretty well. And the other reason is also because we've had the invasion of Ukraine by Russia last year. Plus, we've also had the ongoing banking crisis. So whenever there's crisis of in markets, geopolitical crisis or financial crisis, gold becomes an attractive asset class again. So these are some of the reasons why gold has held up relatively well despite real rates rising. Next, we are looking at the weekly chart between the US 10-year bond yield and the gold. So 2022, similarly to what we saw with the US equities, as bond yields rise, dollar index rose, gold was actually in a downtrend. And then when bond yields peaked, they started to pull back. The dollar was also pulling back, is when we saw gold rising again. So as you can see here, these blue lines here are marking the peak in the 10-year bond yield. So as you can see, with every peak, gold has gained quite considerably. So right now, even here, because of the ongoing crisis and with bond yields falling, gold has hit about $2,000 per ounce again. So it's quite important to track, to at least find to find a top overview, to look at bond yields, real rates, and gold in tandem, so to give you the complete picture. And then depending on your trading strategy or your style, you can look at the daily chart or the 4-hourly chart or 1-hour chart and do your technical analysis to find entry and exit points, be it long or short. Okay, next we shall look at oil. Okay, oil has been a very interesting story for 2022. So, okay, because of the Russian invasion, energy commodities spiked in the first half of 2022. We all saw oil hitting as high as how high did oil go? WTI went as high as $120 per barrel. So what the US government did, the DOE, the Department of Energy, under President Biden's emergency release, they actually approved the release of oil barrels from the Strategic Petroleum Reserve. So the US government has actually released 180 million barrels from June to November of last year to help or to put a cap on oil prices. So when the market was flooded with oil barrels from the SPR, it actually helped to drive down the futures prices, right? So this orange line is the SPR. These are inventory levels. So as you can see, as more and more barrels of oil were released into the market, it helped to push down the price of WTI oil. And the blue line is showing you the weekly stocks in the stock level of the general US inventory. So as you can see from June here all the way till November, as 180 million barrels got released into the market, it helped to push down the price of crude oil, and at the same time also the gasoline prices as well. So once, like for the US household, this also is in part with inflation, right? So as you have gasoline prices dropping, people as your energy cost for households is lower, and people generally will still continue to spend on other discretionary and non-discretionary items as well. And in relation to this SPR release again, so the Biden administration has approved a further 26 million barrels to be released from April this year to June 2023. So this is be new supply that will be coming into the market very soon. Although this is just a fraction of the 180 million barrels, but you can see that there's still a lot of supply sort of being forced into the market because of the SPR release. So this generally should keep a cap on oil prices in the near term. Okay, another thing to look, now we shall move on and look at open interest. Okay, so when you look at open interest for futures on the exchanges, we're actually at quite a low level. So what this means is there's less liquidity, which could translate to higher volatility in markets, in the oil price of oil. So this could be in either way, either up or down. Generally, you would like it to be as liquid as possible so that we don't expect any sharp movements in oil. So this is something to take note of. The open interest is relatively low, and this means the oil markets are less liquid than they should be, and this could generally translate to higher volatility. Next, we shall look at money managers US futures market market positions. Okay, so what are money managers? Money managers would be your hedge funds and your big financial institutions that take a view on WTI oil in the futures market. So similarly, the number of money managers who are net long have reduced quite significantly as well. And this is important. So when we overlay this money managers net position with the price of oil, you can see there's a general trend. So as money managers positions rise, you can expect the price of oil to rise as well. So you can identify the longer term bull and bear trends of the price in oil as well. And once you have identified the longer term trends, you can once again, according to your trading style and strategy, you can break it down and look at smaller time frames, daily, 4-hour, 1-hour, hourly charts, and then perform technical analysis to identify your entry and exit points, be it long or short. Okay, so here is the weekly chart for WTI oil. So we've done a Fibonacci retracement here from this is in June at about 120 to the recent low here. So we've identified the major points for resistance and support levels for oil. As you can see, as the US flooded the market with oil from June to November, that's when we had this steep correction in the price of oil. So knowing that the market was being flooded, you would be identifying positions to capitalize on this downtrend. And then once the SPR release ended in November, oil actually just consolidated between $69 and $82. So once you were able to identify, at least on the weekly chart, that the price of oil is ranging, you can zoom in into the daily and 4-hourly time frames to identify positions using technical resistance levels and Fibonacci, for example, to identify entry and exit positions, or entry and exit points. Okay, and then just this one. Okay, then the last 2 weeks we've had this big move down in oil, partly due to the banking crisis in the US and Switzerland. So now, why would a banking crisis impact the price of oil? Well, because whenever there's a crisis, people tend to think recession. Recession leads to high unemployment, low economic activity. So when that happens, there is a naturally pullback in demand from oil. So as with every recession or fears of recession, there will be a big pullback in oil, which is what we saw in 2020 as well. When economies closed down, demand for oil pulled back or dropped sharply, and hence the price of oil dropped. And once economy started picking up or reopening and picking up, the price of oil picked up again as demand comes back online. So similarly here, so the banking crisis here started a fear of recession, and thus we would we saw this big drop in the price of oil. So moving forward, as we know, we will have more oils coming into the more oils being released by the SPR. So we can expect the current resistance to be around $69, $70, support at about what is this, about 65, I believe, 64, 65. So this will be some of the levels to look at for oil, and the second resistance will be about $82. And here, okay, so this, I'll just like to end this session with some of the major economic events to look out for this week. So today we had the German IFO Business Climate Index, which was released at 4 p.m. Singapore time. And then we have, okay, tonight or early tomorrow morning, we have the Bank of England Governor Bailey, who will be speaking. So this will be quite impactful for the pound dollar. So so any of your forex pairs with the pound, this would be impacted. This could have a potentially strong impact on those currency pairs. And then we have the Australian retail sales tomorrow morning, then followed by, on the 29th, we have the crude oil stocks. So they have two agencies that report on the weekly crude oil stock. So as we mentioned previously, as crude oil, okay, I don't think I mentioned this, but we look at inventories, because as inventories build or go higher, that generally means that there's less demand for oil. So if inventories go up, which is what we saw here, okay, I quickly go back to this. So if you look at this blue line here, this is the weekly stock of the US inventory. So at the start of this year, inventory has actually shot up pretty quickly. So when inventory increases, it means there's less demand for oil, because the oil is not being consumed as quickly as expected. So when that happens, it means there's less demand for oil. So less demand for oil translates to lower prices. So which is what we've seen here as well. So these two agencies report on a weekly basis. So it's good to track this these indicators, these news events as well for if you're trading oil. And next up on the 30th, we have German CPI numbers and the US GDP. And Friday, we have a full day of economic events coming from China, Germany, UK, France, and the US as well. So I think, yeah, I've come to the end of my presentation for today, but let me just quickly check if there are any questions. So I'm sorry, let me see. Okay, I don't think. Okay, there's no real questions. So okay, so I hope this has been a good session for you guys. So maybe just a quick takeaway for oil. Overall outlook for oil would be bearish, given what we have discussed earlier. For gold, oh yeah, I can bring up my charts. Okay, hang on. Let me switch screens and we can go to right, okay. Yes, okay. So now this is the US 500 here. So this is the daily chart. So okay, let's identify certain support and resistance levels. So okay, so we see the support level at about 3,900, and with the first resistance at about 4,040, and the second resistance at about 4,190. So right now, S&P 500 is in between these two these two levels. So I would say probably for me, I would probably have a neutral outlook here. If S&P 500 or the US 500, sorry, comes back up to 4,050, this potentially could be a bearish reversal here. And similarly, if it comes down to the first support level here at about 3,900, this could be a potential bullish reversal. Next, we shall look at gold. Okay, so the first resistance for gold is at about 2010. The first support is also in line with the Fibonacci at 38.2%, which is at about this is about 1,940. So again, it's in between two levels here. So probably if gold comes back to around the first support level, this could potentially be an area where we could have a bullish reversal as well. So once again, I mean, you have to take everything into context together with the fundamentals and the technicals, and try to identify the best, I guess, entry or exit points based on your trading strategy or style. Right. So I think with that, I will end my presentation, the webinar today, and I hope. Hang on. Okay. And I hope this has been an informative session for all of you watching today. All right. Thank you very much and have a good day.